Welcome to today's webinar Wednesday. We are here with Shane Theriot with Edward Jones right here in downtown Katy. Shane's been an ambassador of the chamber. He's been a very good member of our chamber for some time now, and we're glad to invite him back here for a mid-year market update. Shane?
Good morning, well, good afternoon now, 12 o'clock, we just hit it. Hope everybody's staying safe out there and doing well and things are returning in your personal lives to some kind of normal. But I wanted to take some time today to share kind of a recap of what happened during the first 6 months of the year briefly, and then kind of give an outlook for what to expect during Q3 and Q4 of this year, and possibly looking forward to early 2021. So we'll just get the ball rolling here. In the first half of 2020, so the first 6 months, we saw the largest pullback in markets since the Great Recession in 2008. At the end of the day, it came out to between 35 and 38%, depending on which numbers you're crunching. It was the most unique economic event due to a self-induced shutdown driven by the global pandemic, which became a biological crisis that had nothing to do with economic issues whatsoever, like the 2008 mortgage crisis did. This has also been a market event with the largest daily swings in decades. So since 2008, 2009 mortgage crisis, we saw a few bumps in 2015, 16. And if everyone will probably remember the 2018 December, those were some bumpy months. And 2020 started off fairly well. It's the highest that we've been on the market in recorded history in mid-February, followed by a very sharp downturn March 23rd. Congress and the Fed unleashed the largest fiscal and monetary stimulus packages in history, and they also did it the most timeliest. If you'll think back to 2008, 2009 mortgage crisis, there was fiscal stimulus and a monetary response from the Fed, but they were both very delayed, which I think probably contributed to a little bit longer return to a normal economic recovery than it could have been. I mentioned just a while ago that this pullback was due to a biological event, specifically coronavirus or the COVID-19, instead of an economic condition contributing to that. And it's the first recession we've experienced in more than a decade, which ended our longest economic expansion in our recorded history, almost touching on 11 years. Back in February, you may remember hearing all over the news, which is what everyone's paying attention to these days, that unemployment was at 50-year lows. Historic is what it was referred to, but 50 was the actual number of 3.5% back in February, followed by the largest unemployment number since the Great Depression in April at 14.7% unemployment. And we're hovering right now around 11.1, depending on what articles you're reading or what newscasts you're watching. So unemployment is coming down as people slowly get back to work and economies reopen. The economy contracted by 5% in Q1 and shrank by nearly a third in Q2, which was expected. If you were on our previous economic outlook call, we discussed what we expected for Q2, which was going to be dismal numbers at best. And those actually proved to be true. From January 1st to January 30th, however, if you just look at that holistically for that period of 6 months, the market was actually only down 4% because it had a pretty significant recovery very quickly as we moved into April and May. The first half of this year contained all-time market highs for the stock market. I mentioned in February, the Dow was at 29,551. A global pandemic, the deepest recession since the 30s, and the sharpest bear market drop in recorded history, meaning the quickest to recession over a period of time. It was followed by the third strongest quarter ending Q2 with gains in the post-war era, and the Dow closed up about 17.8% at the end of Q2. US large caps during that period of time also gained 20% from April through June. So that's a good reason why you stay invested, not because of the sharp pullback, but because of how quick recovery can occur. This has been the 12th recession in the last 70 years. Prior contractions or bear markets, so what we call them in our world, lasting an average of less than a year, Actual bear markets historically last anywhere from 14 to 18 months. We usually shoot somewhere in the middle and say 16 months. So you're looking at right at a year to a year and a half. And your bull markets, the ones where the market's consistently moving in upward direction, tend to last significantly longer. Retail sales in June did show some positive indicators for some pent up shopping. People had been delaying with a 7.5% jump in retail sales, almost back to pre-viral levels. Industrial production also increased the most since 1959, so some positive signs there. So with all the bad news out of the way and some glimmers of hope as we've rounded out the first 6 months of the year, some things that we could look for through the front windshield for the second half of the last 6 months of this year. So in the last 70 years, when the stock market was negative at the midpoint, so at the end of June, the average gain in the second half of the year averaged around 3% for the next 6 months. Of course, history has a tendency to repeat itself, but it's never a guarantee. But we do expect some movement in an upward direction in Q3 and Q4. Stocks are down, they're not out. We don't anticipate a repeat of the massive pullback that we experienced in the first half. I think we know now as not only a country, but also globally, when you shut all economic activity down for any reason, of course, markets are going to follow suit. One, because businesses can't do business, and two, you've just created this immense amount of uncertainty in the human mind. And really what controls market movement is our consumer confidence. Specifically in our country, we prop up about 70 to 75% of the economy. Corporate profits, we mentioned, were going to be pretty nasty at the end of Q2, and that proved to be true with some glimmers of hope in there. But we expect them to rebound as the year progresses. So they should get better in Q3, better in Q4. Of course, there will be corporate earnings expectation revisions, which will also help some of those numbers, meaning it's always good news when companies hit their targets. And if they revise their targets lower because of the current economic environment, it would make sense that they would show some improvement. We think the second half of this year could resemble a W or a Nike squish shape, meaning we expect some bouts of volatility that we'll discuss in a minute for various reasons. But we are looking at recovery continuing for Q3 and Q4, barring no unexpected events like some massive war globally or a massive trade war with China, which we'll also discuss soon. We do expect that since at the end of this month, actually in the coming days, that the additional $600 per month unemployment benefits will be continued. We don't know exactly what that's going to look like. I read an article this morning that the Senate is aware that the House is right. We do need additional stimulus because there are many Americans still not back at work. So we do think that by the end of August, or hopefully by the end of August, that we'll see additional fiscal stimulus coming through Congress and then passed by the president to continue suspending the markets and consumer confidence to keep the markets up. Monetary stimulus from the Fed, we expect them to keep their foot on the pedal. We expect to see continued low interest rates to spur consumer demand as far as lending is concerned as well. Bouts of volatility, I mentioned, will be expected to continue for the rest of this year due to many reasons. Specifically, viral concerns. A potential second wave has been discussed, like what does that look like in the fall? The availability of treatments and vaccinations. So if you've been haphazardly keeping up with the news, you know there are multiple vaccinations in development globally, not just in our country. There are also various treatments that are being discussed, like anti-inflammatory options like steroids that are already on the market and have been since the early 60s, as well as antiviral treatments. You've probably heard of remdesivir. That one's lesser in the news now than what it was just a couple of months ago, but all of those options are still out there for treatments and then vaccination development. There will be periodic setbacks in economic reopening, specifically localized. If you've heard as of late, there have been an increase in number of cases in many states. Actually, I believe only 2 states it's reduced, and it was the 2 that were initially at issue New York and New Jersey, but multiple other states, and I'll name Texas right here at home and Florida as two of the economies as state governments that are experiencing increases in the number of cases. You're going to experience that anyway, just because we have mass quantity testing available, just delayed results. So when you see the numbers, they're usually a result of delayed reporting because of how long it takes to get your results back. And then additional reasons for bouts of volatility for the rest of the year. Certainly, we don't want to forget the political uncertainty as we near the November election. That's normal whether we have a pandemic or not in election years, just because of who's going to win and everybody's nervous, and that creates some issues with consumer confidence, which impacts the market. So we would expect as we get closer to November, more volatility in the market. I don't know exactly, how to describe how large the swings could be, but certainly it wouldn't be uncommon to see anywhere between 1% to 5% as we near the November election. Some other concerns that we would want to keep in mind for coming months and bouts of volatility would be trade tensions with China. Just read an article this morning that the Houston embassy for China has been closed or is closing due to some expectations that China may have been eavesdropping or taking trade secrets with the oil and gas industry here in the Houston area. I thought that was pretty interesting. Continued unemployment claims being filed weekly. Those numbers come out on Thursday. But over the last several weeks, it's continuously been declining, it being the number of unemployment claims. We do expect weak global growth because economies are going to recover unevenly, meaning your major economies might recover quicker than your third world countries, for example. And then we also have issues with education. School should be starting here in the next couple of weeks, mid-August for many schools, at least in our country. And what does that look like? Specifically for dual working families that have small children, where mom and dad depend on the school system to take care of their children during the day while they're at work. So what does that look like for the economy, and specifically spending from those families if one of those individuals has to stay at home because they can't come up with another way of taking care of young children? So those things are important to keep in mind. Back to the political discussion, interestingly enough, historically presidential elections have made no difference in long-term investment returns. So that's something to keep in mind. Here at Edward Jones, we call it don't play politics with your portfolio, meaning you don't really make adjustments to portfolio allocation and diversification just specifically because of upcoming elections. So keep that in mind. We expect markets to remain sensitive primarily to headline news, meaning what you and I read and absorb either on social media, from watching it on local news channels or national news channels, or our reading source or podcasts of choice. Keep those things in mind. Headline news dramatically impacts consumer confidence, certainly if we are using that to make emotionally driven decisions with our investment portfolios. We also expect COVID to remain in the driver's seat for at least the next 6 months or until we have a vaccination available. Meaning, as you see headlines about increasing cases, local governments closing, a potential second wave, those things could impact us psychologically, whether we feel comfortable with spending money. That also impacts us with how we feel about our job security as well. I would call it the Texas two-step. Expect 2 steps forward, 1 step back as we navigate through Q3 and Q4, meaning the market, we expect to continue moving in an upward direction, but there are going to be momentary setbacks due usually to headline news or some release of data, like if we would see an increase in unemployment claims over what the expectations are for the decreases we've been experiencing. Also in Q4, primarily, we would expect to see an increase in the number of bankruptcies because we will have run out an entire year of people using what available cash flow resources that they had. We've already experienced well over 100 US large companies filing for bankruptcies just through the end of June, and would expect many more. What we're going to continue seeing through Q3, Q4 of this year is companies continuing to distinguish themselves into one of 3 categories: the cans, the goods, and the can'ts. The ones that can continue to do business, the ones that could if they can figure out how to function in this new environment, and the can'ts, the ones that just cannot make it and eventually end up filing for bankruptcy or going out of business. One subject that's close to home for us here in Texas is oil. If you'll remember the very massive pullback in oil at the beginning of the year, specifically during the shutdown initially back mid-March, late March, oil is continuing its road to recovery as people do resume working. And eventually it'll return to normal when people feel comfortable traveling the skies and the seas again. You wouldn't realize how much those impact the oil and gas industry, but they're massive. They're major impacts when travel and leisure are impacted, and that dampens oil consumption. Just read an article this morning that said US consumption prior to the pandemic was about 13 million barrels, and it's reduced to 11 million barrels now. So 2 million doesn't seem like a lot, but you're seeing it at the gas. As consumer confidence returns, people return to work, manufacturing and home sales increase, retail continues its upward movement. We'll see that markets will price that in, meaning markets should continue moving in upward direction. Just don't forget to be prepared that there will be momentary setbacks. We don't expect to see output and activity levels return to pre-pandemic levels swiftly, meaning we would expect to see that return of level of activity sometime in 2021. We do not expect gross domestic product or GDP to return to pre-pandemic levels until further out, so like possibly 2022. Currently, we're in the early stages of an economic recovery. We could expect to see some positive GDP numbers in the second half of this year. But it all depends on how subsequent shutdowns, if any, are necessary due to a potential second wave would occur. I mentioned we'll have the haves and the have-nots. Certain industries will experience lingering impacts. Specifically, the ones that I'm naming are travel and leisure and social activities, like sporting events and concerts where people get together in large quantities or in enclosed vessels of some kind. The economy is expected to grow at modest but sustained pace as we move through 2021 and beyond. We're looking for some level of normalcy in markets and potentially less volatility as we move into 2021 with the hope and the expectation that we'll have an FDA-approved vaccination. It really boils down to a lot of psychology. So people have compared this to the flu or perhaps pneumonia. Those things currently do kill more people than what coronavirus does, at least according to numbers. However, there are treatments and vaccinations available for those things. Whether you choose to utilize them or get vaccinations or not, they're there, which creates consumer confidence. One of the issues right now, I mentioned consumer confidence drives our market, is we don't have a vaccine and we're testing treatments, and we don't like that level of uncertainty. So it's a psychological part of this as well. Our expansion is expected to be durable. The pace of our recovery will be influenced by progress on vaccinations and treatments. I've mentioned previously, this started with a viral event and likely will end with a vaccination. You got the two V's going on there, and we'll bring a third one in if this would be a V-shaped recovery for this particular recession. It was a very quick pullback in the market, but we expect recovery to be a much longer, which is why I mentioned that W or Nike squish shape a little bit earlier. Currently, just FYI, read an article Monday. There are 197 vaccinations in development around the world. None are yet approved by the FDA in our country, and 2 are in stage 3. So that could expedite how soon we get a vaccination. Again, like I mentioned on our last update call, the question becomes how effective is it as a vaccination? How long will it last? And then how do we mass produce and distribute it? So once we have a vaccine, it doesn't mean all of our problems are solved, because we have those other nuanced details that we have to figure out in order to make this work, not just for our country, but globally. Because whatever company figures out that magic dose of vaccination is going to have to figure out how to mass produce it. And I'm sure there will be some synergy between multiple companies that have the ability to produce.
Has the consumer confidence gone up with the recent news of those 2 vaccinations going to phase 3?
I don't believe so. And the reason I say that is if I'm using the market as just an indication of consumer confidence, it's been pretty level the last couple of weeks. We've been hovering right under 27,000 on the Dow for quite some time now. So I would say consumer confidence is leveled off. We're not ready to bust that 27,000 ceiling yet, just simply because we're comfortable with where we are in the market right now, and it's going to take some pretty earth-shattering news as far as treatments and development for vaccines are concerned, or just treating the virus should you get it, like decreasing the amount of time that you have it with steroids or an anti-inflammatory of some sort. I mean, I'm not a healthcare professional, but I think that consumer confidence will return when people get back to work, because there are treatments available for the virus, like you know, steroids of some kind or a vaccination specifically. Let's see. So we expect most major economies will likely experience a sharp snapback in Q3 due to some additional pent-up demand, meaning just I want to get out of my house and get out there and be a little social and spend a little bit of money. But we expect it to be gradual, and I mentioned uneven earlier, as pent-up demand fades as the year comes to an end towards the end, November, December, around the election time. The pace of recovery will largely depend on how well countries are managing the ongoing health crisis globally. So each economy and each government's doing their own thing. There isn't a synonymous treatment or anything along those lines available. Generally speaking, most people are just adhering to wear a face mask, social distance, wipe everything down at the end of the day, as preventative measures. We expect inflation and interest rates to remain low. We know the Fed has said they will maintain low interest rates possibly through 2022, which is good for you and I as consumers. That'll keep the cost of goods where they're at, rather than increasing due to inflation, and it'll allow us to borrow money for various reasons, buying homes, buying cars, refinancing debt. So we'll get out there and we'll spend some money to spur demand. Since 1950, every instance in which the stock market rose more than 30% from a bear market low turned out to be the beginning of a bull market. So I mentioned we had that 35-38% pullback at the beginning of the year. So potentially, I'm not saying that it is, because I don't certainly have the crystal ball, which I wish I did. It could be the beginning of a bull market when the market started recovering back in March after that massive pullback. What we would hope to see, so some hope, keeping it optimistic here, is incremental progress towards treatments. I mentioned the 197 vaccination trials that are occurring currently, and a continued reopening of the economy and an ongoing reduction in unemployment claims like we've been seeing, as well as a rebound in corporate profits as you and I get out there and start spending money. Recovery will continue to be fragile. I mentioned bouts of volatility earlier, and the bouts of volatility and the fragility will depend on fiscal intervention, which I mentioned we could potentially see as early as August, since the money runs out at the end of this month. A positive headline news, since that seems to be a big contributor to consumer confidence, the availability of treatments, like I've mentioned a few times, and then the consumer confidence increasing because the treatments are available. I think at this period of time, you should focus really on what you can control. Your investment decisions should be guided by your long-term strategy and goal-specific reasons for savings, not your emotions or headline news. Disciplined portfolio diversification and periodic adjustments when necessary will help keep you on track. Staying invested is the best way to participate in longer-term returns. It's a good time right now for a combination of optimism and realism. Position your portfolio in alignment with your goals and calibrate your expectations and diversifications for inevitable bumps that are going to occur along the way, as we navigate the rest of this year. Time in the markets matters more than trying to time the markets. And time in the markets is one of the most powerful drivers for long-term returns for a diversified portfolio. Staying invested over longer periods of time increases an investor's chances of earning positive returns And the percentages rise as the time invested increases, generally speaking. A 35% decline from February's record high to a 44% rally from March's lows, that is why you stay invested, because the return or the recovery can be as quick as the pullback. Some actions to consider for the rest of the year. If you have the time and the inclination and possibly the resources for some of these to actually take some action to improve your financial lives. Fully funding your traditional or Roth IRA. If you're under 50, that's $6,000 for 2020, $7,000 if you're 50 or older. Consider Roth conversions. If you've been laid off, or if you're in a lower tax bracket, or you don't really know what the rest of the year is going to look like as far as income is concerned, you may consider doing some Roth conversions and getting some of that tax deferred money moved over to a tax-free option. Before you do that, consult with a CPA. They need to crunch some numbers to see if it's going to make sense, and certainly we wouldn't want you to go willy-nilly and do it yourself and get thrown into a higher tax bracket. Tax loss harvesting, it's a mouthful, very tongue twister. Using your losses on investments in non-retirement accounts to offset gains you have in non-retirement accounts for tax purposes. Again, that's something that you would want to consult a CPA with. If you don't have one, I would encourage you to reach out to one, because they're experts on helping you with tax loss harvesting suggestions, or work with your financial advisor. They'll make recommendations as well. Rebalancing your investments when and if necessary to ensure that you remain within your comfort with market fluctuations, because there will be more. Check your diversification. Reallocation, rebalancing, and diversification all sound synonymous, but they mean very different things. What I mean by that is fixed income rose a little bit during this particular first 6 months of the year, but your equities took off quite a bit if you had a large quantity of those. So if your portfolio objective or diversification allocation should have been a 60-40, you might be slightly overweight at this period of time in equities, like 65-35. So you might need to make some changes to get yourself back in alignment. If you're bold enough, I would say you should lean into equities, because with the market still being down below the market high in February, there's still room to move, but you want to be strategic about the equities you move into. Obviously, I mentioned the haves, the have-nots, or the can'ts good and the can'ts. You've got some tech companies that are performing exceptionally well. So if you bought currently, you would be buying on a market high for them. And there are other companies that may be struggling, like the travel and leisure industry. Some oil companies still are underperforming. So be careful about what you're purchasing, and if necessary, consult with your advisor or find an advisor. You're certainly welcome to give me a call or shoot me an email anytime. If you can afford to, for cash flow purposes, increase any work retirement account contributions that you're currently making to ensure that you can max, if you can afford that. If nothing else, at least ensure you're contributing enough to get the company match, because that's free money for you. I have a note here to upgrade to quality investments. So investments might be great one day and they might deteriorate in quality a year or so from then, or at any time in the future. You might want to just double check the quality of investments that you currently have. You can cross-check those with your financial advisor, or you can even look online through Morningstar is one that we use. It's a third-party company, but it allows us to screen investments to check quality. Systematic monthly investing, we call it dollar cost averaging in our world. It's how you currently contribute to your 401k at work if you've got one where you contribute a little bit every month. Something to consider because it removes the timing issue. So you're buying sometimes when the market's up, sometimes when the market is down, but that's something to keep in mind if you want to get into the market if you're not in it. Consolidating old outline accounts or former 401ks with companies or IRAs that you may have strewn about at different financial institutions will help you to simplify required minimum distributions in the future, simplify the number of 1099s that you get down to one, the number of statements that you receive down to one, and overall it can ensure that you're properly diversified among all the money that you have in the market. A good review of life insurance policies is a great way to ensure that you're accurately insured. I don't believe in being overinsured, but I certainly don't believe in being underinsured as well. If you're not really sure how much life insurance you should have, get with a financial advisor. You can use our calculator at edwardjones.com. Use the search function in the upper right corner for life insurance calculator, and it takes about 2 minutes to complete and maybe a half a glass of wine. But you'd be able to determine how much insurance you should have. Conduct a beneficiary review on all of your accounts and any policies you may have. So think annuities, life insurance policies, checking accounts, savings accounts, investment accounts, retirement accounts at work, just to make sure your beneficiaries are exactly how you want them to be. Refinancing debt. I just read an article this morning. Mortgage rates are at historic lows, actually below 3%. The article mentioned 2.89 with perfect credit. That is amazing. So with refinance, you have to keep in mind you do have to pay closing costs. But if you have a mortgage rate upwards of 4 or 5%, it might behoove you to look into getting that refinanced, as well as auto debt. If you have an auto loan, you may be able to refinance at a lower interest rate. And then the last thing I have on my actions to consider is something fun. So I mentioned travel and leisure industries are hurting right now. So you may consider looking into booking future vacations in 2021 or beyond, assuming that they'll allow bookings that far out. But word of caution, you might want to consider trip insurance and finding out the nuanced details of the trip insurance. I have heard rumors that some of the trip insurance policies that are out there will not refund your money if it's due to a pandemic, which is what we're currently experiencing. Matt, that's what I've got.
Well, thank you. A few questions here.
Sure.
With the extension of unemployment benefits with phase 4 possibly, how will that affect the market and potential unemployment numbers moving forward?
So it could impact unemployment numbers. There are people who are actually making more money on receiving unemployment than they were actually at work. So what does that mean as far as the number of people re-entering the workforce? I don't know. I mean, the numbers are not always 100% accurate, just like the number of coronavirus cases. You know, there's delayed reporting there as well. But the additional stimulus would continue to instill some consumer confidence on whether I decide that I want to go eat out at a restaurant versus eating sandwiches at home. If I've got that little extra cushion. I mean, and there's various options on the table right now in Congress about what that looks like. So does that mean reducing the 600 to 300? Does that mean tying it somehow or another to your previous year's annual income as reported on your tax return? That's all in Congress's hand right now, but I think continuing to provide some level of stimulus will keep confidence at least where it currently is as far as how comfortable our people are with spending money. For unemployment numbers, people have, as we've progressed through the 6 months, started going back to work. Some were furloughed, which meant they'd have the ability to come back when the work was there, basically. There are people who are showing that they're employed, but they're working under reduced schedules. So maybe instead of 40 hours a week, they're working 30 hours or 20 hours a week, but possibly receiving some type of unemployment benefit. So the numbers, hopefully, because we don't have that crystal ball, for unemployment claims will continue to decline, and stimulus will come hopefully sooner than later, since the money runs out at the end of this month.
What additional resources would you provide for best and most accurate up-to-date information on the market?
On the market, there are a couple of news articles that I have delivered to myself every day. One is Morning Brew. I really like that one because it's a brief synopsis of what occurred in the market the day before. It gives you insight information on when companies are going to release corporate earnings. And then gives you each day of the week which companies are going to release that. And it gives you good tidbits about what's going on with some specific companies, which you could consider some opportunities if you wanted to look into it. And then the other one is called The Hustle, which I like, which is also, Morning Brew is in your inbox at 5:30, and The Hustle, I think, comes out around 7. You can always, of course, reference Edward Jones' website, but it's going to be more market investment specific. If you're looking for just good overall news, there there are so many sources out there. You know, you hear so much about fake news these days. You really want to know what's reliable news. So what I prefer to do is get my news from multiple sources and then form my own opinion on what I think is the most accurate information.
Great. Well, thank you. That's all the questions we have today. Thank you for your time. Thank you for the mid-year market update. We are excited to have you back on September 30th for another market update. So between now and then, hopefully we've got some new things to progress on and a little bit more stabilization moving forward. So thank you again for your time, and we'll see you in a couple months.
Sounds good, Matthew. Thank you for having me.
Absolutely.
Stay
Bye
safe.
now. You too.
Bye-bye.